Hello and welcome to today's live technical analysis. We're going to be starting off with the euro against the US dollar. So, as you can see, it failed to break above our resistance level of 1.0875 and then retraced lower to our support level of 1.0795. So, essentially, meeting sellers and buyers between these two levels. Now, it appears to be a tug of war with it failing to break above R1, but this is a higher low, and I wouldn't say a higher high, as you have this high that has yet to be broken. As such, I would switch for a sideways bias between S1 and R1. The RSI is at 60, so implying some bullish tendencies may remain in the particular pair, in addition to perhaps an upwards moving trend line that has been formed with two touches. So the wick of this bearish candle and then this bullish candle at this point. For it to be validated, however, we would require another candle touching on the upwards moving trend line and validating its upwards direction. Now, based on what we're seeing, our site's still at 60, so some bullish tendencies. It might take another stab at the resistance level. If it moves higher and fails to break above R1, I would maintain a sideways bias. Even now, I would not maintain a bullish bias based on the fact that we're seeing the Bollinger Band narrowing, implying some low market volatility, and we're expecting the ECB's interest rate decision later on this week. As such, the euro may remain in relatively sideways fashion between S1 and R1, leading up to the decision. From a personal point of view, I expect the ECB to be slightly dovish because the ECB is made up of the member countries of the euro. Whereas in the US, you simply have the Fed, which is from the Federal Reserve governors across the United States, and it's one country. Whereas in the euro, you have multiple countries, so difference of opinions. Germany is experiencing some, say, economic hardship, so they might be a bit more uh, placing some pressure on the ECB to be a bit more dovish. France, Italy, and Germany all have their own different agendas. As such, the ECB is a bit more, I'd say, likely to be a bit more dovish in comparison to the Fed. But overall, sideways between S1 and R1. If it breaks above R1, we could switch for a bullish outlook, taking aim for this old high, which is resistance at 1.0935. On the other hand, should it break below S1 of 1.0795, we could switch for a bearish outlook, taking aim for 1.0725, which coincides with the beginning of the upwards moving trend line that we had drawn just a few moments ago. In terms of financial releases, you have the CPI, and I would place emphasis on the core CPI for the US, expected to accelerate at a decreasing rate from 3.8 to 3.7%. Now, that would imply easing inflation pressures in the US economy, which could allow the euro to potentially strengthen on the back of a weaker dollar. Should that come in higher than expected, however, so 3.8 or 3.9, then we might see the greenback strengthening as concerns about persistent inflationary pressures persist, thus could weigh on the euro. Therefore, could come back down to S1 if it stays near R1 up until the release of the CPI rates. In terms of Fed speakers, we had Minneapolis Fed President Kashkari and Chicago Fed President Goldsby speaking yesterday. Now, as usual, Kashkari was hawkish, implying that 3% is 3% and the bank's target is 2. So we have provided some support for the dollar. Then we had Goldsby being dovish, as was expected. Yet a sentiment appears to be emerging from Fed policymakers in regards to housing services inflation. So essentially, the housing market appears to be a thorn in the Fed's backside in terms of persistent inflationary pressures. So I would place emphasis on financial releases in terms of housing stemming from the US, possibly dictating the way the Fed policymakers pivot in terms of dovishness and hawkishness as they are speaking. Now, for now, however, I would switch for and maintain a sideways bias between S1 and R1. Dollar JPY, it's 151.95, so it's nearing this level. Now, the Bollinger Bands have widened slightly, but still remain narrow relatively. RSI at 54, implying low market volatility. At 152, we may see a government intervention, as has been stated by Bloomberg. We're all expecting, I'd say the market is expecting a potential government intervention above 151.95, so around 152 or 153, which could provide some support for the JPY. And such, even if we do maintain a slight sideways bias, if it reaches above 152, I would not be surprised to see a market intervention, government intervention in the FX markets, which could provide support for the JPY and could actually take aim for 150.82. If it breaks below, S2 is 149.20, S3 147.60, and then S4 146. If we don't see a government intervention, the next potential target after breaking R1 could be R2 at 153.80. But once again, I would personally anticipate potential government intervention, which could provide support for the JPY above the $152 mark. So we would maintain a relatively neutral bias, so sideways bias between S1 and R1, unless it breaks above R1, then temporary bullish outlook, and then bearish since we are expecting a potential intervention. Moving on to the dollar against the Canadian. So US dollar against the loonie. Now we're seeing attempts to break above. It had broken above R1, so we're switching our resistance level 101.3630. So simply readjusting our R1 level, we're keeping R2 and R3. S1, we could move slightly higher at 101.3520. RSI at 50, so I'd maintain a neutral bias as well for the dollar against the loonie. Now, the loonie might find some support from rising oil prices. As such, should oil prices move higher in terms of geopolitical tensions. So over the weekend, we had Mexico severing diplomatic ties with Ecuador after they stormed their embassy in Ecuador's capital, if I'm not mistaken. So we're seeing rising tensions in South America. Then you have the anticipated response from Iran following the alleged strike by Israel on Iran's consulate or embassy, if I'm not mistaken, in Syria. So that's a risk. So despite the potential peace talks between Israel and Hamas, you still have elevated geopolitical tensions. And personally, I would expect a retaliation by uh, Iran backed groups such as the Yemeni Houthi rebels or Hezbollah against Israel, which could lead to oil moving higher, in addition to gold, which is forming a new all time high as we're speaking, $2,358 per ounce. So if oil does move higher, I would not be surprised to see the loonie gain against the US dollar. For now, sideways between S1 and R1, narrowing off the Bollinger Bands, RSI as well. British pound, same story with the euro. So if you see, it's relatively similar. RSI 59, so some bullish tendencies. Now for the British pound, our R1 level is closer than that of the euro. So the euro is slightly higher, whereas the British pound is currently being tested. If it breaks above R1, we would switch for a bullish outlook, taking aim for R2 at 1.2775. Aussie. The improved sentiment surrounding China might be providing support for the Aussie as well. So if China is on the road of economic recovery, we may see the Aussie gaining. Upwards moving trend line, that's one. At a steeper angle, we could draw an upwards moving trend line from here, roughly the beginning of April. We're seeing higher lows. So it's broken above R1. That was old. So this is new R1, 0.6615. R2 is our old R3. Support, we can bring it slightly higher, and then we can bring S2 as well. So we're going to be readjusting our support and resistance levels. And we can bring it higher because it's moving higher. So it's trying to break R1. So support might be closer based on the price action. Bollinger Band is tilted to the upside. For the Aussie, I would be bullish as long as it manages to break R1 today. If it doesn't break above R1 in today's trading session, I would switch for a sideways bias between S1 and R1. S1, which we are going to be placing in just a moment. So taking this wick, validated on 2 occasions, so that's good enough. 0.6725. Let's just make sure that is still validated. Actually, well, let me keeping at 0.7. Looking at this. So this becomes R3, 0.6727. So have R1, R2, and R3. Once again, it needs to break above R1. Otherwise, no bullish outlook. Bringing S1 slightly higher, reflecting this wick, and then this price action here. So as a support level, 0.6559. Then S2 at the beginning of this upwards movement, taking the most candles possible. So let me just show you why. If we take these three candles instead of this one here or this high, just have a look at the price action that preceded this accumulation of buy orders. Just look, came back up, but we have a new resistance level, which is why we're ignoring this here. Came lower, look at S1, tried to pierce through, failed, moved lower. At this point, which I'm going to be adding a rectangle now just to make it even clearer. You're seeing a lot of support. So you have multiple candles trying to reach down to S2, 0.6480, but have failed. 1, 2, 3, 4, 5. Came back up, tried again, didn't even reach S1, and then managed to break through, came back up, found support once again. So the bears won this battle, but then the bulls swiftly came back in and took over, finding numerous support levels, pierced through, but then the bulls came back in. So it took out anyone that was potentially with a stop loss at this candle, found some liquidity, accumulated buy orders. So it was, I'd say, a tug of war between the bulls and the bears. So essentially at this level, we're seeing a lot of action. So taking it here, taking this as a swan, look at how much we're ignoring. We're ignoring multiple candles that found support at near or at this level. So I'm ignoring that, and I would opt to take support at the closing and opening of the bullish and bearish candles respectively because of the prior historical data. There's no use in me placing my S1 here right now when the price is up here. Now, if we were seeing moves like this on the daily, then perhaps yes, it might have been prudent to keep S2 now in expectation of a big move. But if you see at the grander scheme of things, look at the candles. Now, this is a 4-hour time chart. You're seeing small, some big moves. So if it breaks R1 with this 4-hour candle, I wanted to see come back down to resistance, turn to support, validate that this is now support, and then move towards R2. If it doesn't, retracement lower, perhaps around here, temporary, and then moves higher. Then we could have a bullish outlook if it doesn't break into these candles. If it does come back down to S1, however, I would maintain a sideways bias. But for now, based on the way the pair is moving, I'd bring S1 higher. We can keep S3 as it is currently, just in case we see a large move in the other direction. And since our live technical analysis is about an hour a day, if we place S3 and then S2 gets broken whilst we're not streaming, makes it a bit more important to have some distance from S2 just in case. So that's my S2, that's my S1, and I'm keeping S3 as it was previously. Now, that doesn't mean that we won't see support here. It's just I believe that the next level of support, of heavy support, would be around 0.6507. Let's remove this box. So yes, for now, if it does manage to break above R1 today, bullish. If it doesn't, sideways between S1 and R1. Onto oil, it capped down lower, actually breaking our upwards moving trend line. And if I extend it, you can see that it's meeting resistance at the point where the upwards moving trend line may have continued. So had it come back down, you may have found support, but instead it gapped lower. And now you're seeing resistance on the trend line, which is why I would not be bullish for oil. From a technical point of view, I wouldn't. Our size is at 60, so you have some bullish tendencies, but it dropped from 70. So it could also imply that the bullish momentum might be fading away. From a fundamental point of view, however, we're expecting a retaliation by Iran. Now, tensions in the Middle East could lead to elevated oil prices. As such, you have a conflict. You have the technical, which is saying, you know what, you're finding resistance here, might not move higher. The Bollinger Bands are narrowing between S1 and R1, so low market volatility. Other side's at 60, but declining from 70 implies that the bullish momentum might be fading away. So, technical, I'd expect this to be a sideways moving bias between S1 and R1. So, potentially, hypothetically, going short at R1, taking profits at S1, or going long at S1, taking profits at R1, or partials in between, or whatever. Sideways bias from a technical point of view. From a fundamental point of view, however, we're expecting the retaliation by Iran, which could increase tensions in the region and thus could provide support for oil prices. So this is an interesting scenario. If it doesn't break above R1, sideways bias between S1 and R1. For today, I'd maintain a neutral outlook for oil, so sideways between S1 and R1, but it would be very short term. If we see even the possibility of an action that could be considered a retaliation by Iran, then I would expect oil prices to move higher. If we don't, and we're seeing a more subdued message in terms of a response, then yes, we might see it move in a relatively sideways fashion. But from a more macro perspective, I would be bullish for oil prices. Could actually reach $90 per barrel as well. S1 and R1, we're keeping them the same. There's no reason to change them. You can see that it's been tested twice. It's broken above, so bringing S1 here, there's no real reason to it. As the Bollinger Bands, the lower bound is at S1. R1 tested, no reason to go higher or lower. RSI 60, same with the other support and resistance levels. So I maintain a sideways bias as long as it doesn't break above R1. If it does, bullish, taking aim for R2. Gold, all-time high. As you're seeing this live, this is the new all-time high figure. Let's drop even down to a minute chart. New all-time high, 2,362.75, actually slightly higher. So as we're seeing it now move higher, it's an all-time high. Now, the issue with the all-time high is that we don't exactly know where it's going to meet heavy resistance and where it might move lower. On the 1 minute chart, you're bullish, but once again, it's a 1 minute chart. On the 4 hour, you're at 76. So a bullish market sentiment, but slightly overbought. Now, this could be due to a weaker dollar, geopolitical tensions. Taiwan had reported that it had recorded an intrusion by two Chinese aircraft earlier on today. You have tensions in South America that we noted before. You have tensions in the Middle East. So, from a fundamental point of view, I would be bullish for gold. But the question is, where is it going? We had resistance at 2,350, which was tested around here. It's broken above, so we would maintain a bullish outlook for gold. Now, we placed R2 at 2,400. So the question is now, do we keep R2 or do we flip R1 and just bring it higher? I'm going to flip R1, so switch that to support. It was the all-time high, broken, supported, 2,350, and then that's green. So this becomes S1. Target for the bulls could be 2.4K. Higher than that is 2,450. And then we could put 2.5K as R3. So $50 apart. Upwards moving trend line continues to be validated, so we would maintain a bullish outlook for the commodity. But I would not be surprised to see a market correction to lower ground before it continues on its ascent. And when I say market correction, I'm not talking about a huge move. Potentially 2 4-hour candles that might be bearish. That could be sufficient enough retracement. And if it reaches to old levels, so back down between S1 and S2, that's possible as well. And since we're placing S1 at 2,350, for a bearish outlook, simply breaking below S1 would not be sufficient. For a bearish outlook, it would have to break below S2 before potentially taking aim at S3. R1, 2.4K. R2, 2,450, and then 2.5K as R3. Overall, I would maintain a bullish outlook for gold. R3 to the Nasdaq appears to be losing momentum, so just bringing S1 slightly lower, 17,000, 17,800 for S1. I'd maintain a sideways pass between S1 and R1. In terms of news, you had TSMC yesterday announcing a 6.6 billion US dollar deal with the US Department of Commerce to develop semiconductor facilities within the US. Now, if other companies, such as potentially Intel, receive similar agreements from the US Department of Commerce, it could provide support for the company's stock price. Because if you're receiving money to develop new semiconductor facilities in the US, you're diversifying, so you're not exposed to potential risks and threats posed by a hypothetical scenario in which China decides to invade Taiwan, which could lead to elevated risks. So you're insulating yourself from the risk of geopolitical tensions. And as another note, TSMC is also expanding into Germany. Now, for us, we might be seeing Intel. We're seeing TSMC gaining a grant from the Department of Commerce, which could also say that they might be preparing to support other companies as well looking to improve semiconductor facilities in the US. And one of those companies could potentially be Intel. In such a scenario, we could see Intel gaining. So why are we looking at the Nasdaq 100? Well, Intel belongs to the Nasdaq 100 index. So if these companies are gaining, then we might see the US 100 moving higher. For now, technicals are sized at 50, neutral market sentiment. Bollinger Bands have narrowed between S1 and R1, so implying low market volatility. Look at how the price action has broken between the mid range of the Bollinger Bands. So it's not finding support at the mid range before moving higher. It's broken below. So it's meeting resistance at R1. So I'd maintain a sideways bias between S1 and R1. The next scenario I could see could be bearish if it breaks below S1, taking aim for S2, so a small market correction. If it breaks above R1, however, we would switch for a bullish outlook, taking aim for R2 at 19K, 19.6K. Our favorite airplane manufacturer, Boeing. I would maintain my bearish outlook that I've maintained since the beginning of the year for the company stock price. If I'm not mistaken, over the weekend, Southwest Airlines was operating a Boeing aircraft, the 737, which saw its engine cover torn off. That's bad news for the company. Can continue weighing on the stock price as concerns about safety and manufacturing standards in Boeing continue. Now, we're also expecting the announcement by Boeing to announce how many of their, from mistaken, long air freight planes they have sold. According to a recent report by a news outlet, I'm not sure if it was Reuters, about 11 of those planes are waiting for their engines and have not been sold, which could place limits on the company's operating cash flow, which could further weigh on the company's stock price. Essentially, fundamentals bearish, technicals you have 35, so bearish sentiment, lower end of the Bollinger Bands, lower bound, could correct higher to R1 before moving lower. For our bearish outlook to continue, however, I would require a clear break below S1, taking aim for S2 at 158.35. Airbus moving lower to for today. Nvidia sideways between S1 and R1. No reason to change our support and resistance levels. Bollinger Bands have narrowed. Low market volatility. RSI at 50. Once again, neutral market sentiment. So staying between S1 and R1. Now, the movement by Nvidia could also be impacting the Nasdaq, as Nvidia, one could say, was the primary driver between the Nasdaq 100's index rise over the past few months. As such, if Nvidia is finding it difficult, it would make sense that the Nasdaq as well is finding it difficult to move higher. Apple still hasn't broken below S1, so finding some support around here. Our size is still 38, so implies a bearish sentiment, but for that to continue, it would have to break below S1. Tesla finding support at the 152.65 level we had mentioned, sideways between S1 and R1. That picture does not appear to have changed. If it stays between S1 and R1, we could maintain a sideways bias. If you'd like to take my support and resistance levels, you can simply screenshot and then place it on your own chart and see how the company's stock price moves. In terms of news, the recent news by Tesla could provide some support for the company's stock price, but seems to have been immaterial. Over on to IBM, breaking below RS1. Before we move on to the others, let's see what else we have. If there's anything you would like to see in particular, feel free to ask. You can have a look. As long as we offer it, then we can do a technical analysis on it. Ferrari bouncing off our S1 for 10. Recovering, might be market correction before it continues on its descent. For it to continue, for our bearish outlook, it would have to break below S1. Google stays above S1 of 152.95. Coca-Cola bouncing off S1 at 59.20. Bearish sentiment emerging. Bearish outlook for Coca-Cola, but we would require it to break below S1, so clear break below, not just wicking below. Moving a relatively sideways fashion. One could even say that this is a sideways moving channel. Which means we readjust our R1 61.20. Coca-Cola. On Friday we have bank earnings, JP Morgan, Citigroup, and then next week we might be having. I'm not sure if Wells Fargo is next week, but I do know JP Morgan and Citi are due to release their earnings on Friday, so that might be an interesting. So the banks are beginning the new earnings season. Airbnb based on the eclipse in America over the weekend might see a bit of an uptick in bookings, but that's only one weekend. Might be some support, but overall bearish. Gap lower, filled the gap. Other side below 50, applying a bearish sentiment. We can bring this one lower, 158.70. Key events for this week, I would say, would be the ECB's interest rate decision, RBNZ tomorrow, widely expected to remain on hold. New Zealand dollar OIS implies a 98% probability for the bank to remain on hold. As such, we turn our attention to the bank's accompanying statement. So, New Zealand dollar interest rate decision in tomorrow's Asian session. If you look at the New Zealand dollar, euro, and British pound, similar scenario, but in this case, it's broken above the old high. So, higher highs and higher lows. And as such, from a technical point of view, bullish outlook, upwards moving trend line, RSI at 65. Target, next potential target for the bulls could be 0.6075 as R1. Then R2. What if we take this old high? That's too close to this one. So R1, R2, and then R3. If the bank's accompanying statement is perceived as hawkish in nature, then we may see the New Zealand dollar gaining. If it is perceived as dovish, i.e., cutting rates soon, then we might see it weakening. But once again, the price direction could be dictated from the core CPI rates for the US, which are due to be released not today. So, from a short term point of view, RBNZ interest rate decision tomorrow. For now, I would be bullish. If it reaches R1 and breaks above, you have the upwards moving trend line and RSI as well, supporting this hypothesis. So attention turns to the bank's accompanying statement. We'll have a look at what they've said tomorrow. Support, recent price action. It's too close. Let's take these two candles. Bring down S2 to the beginning of this upwards moving trend line. 0.59954 S1. S2 0.5945. And then lastly, we have S3 0.5865. Once again, if there is something you would like us to see together, now is your chance to ask in chat, or I'll simply do one last technical analysis, and that will be probably it for today. We've done oils, we've done majors, we've done British Airways, we've done Tesla, we have ExxonMobil, IBM, Boeing, done. So S&P 500 sideways as well. Dow Jones bearish, sideways, depending on where you place your support level. But I think the last one that we are going to do for today is we'll do Intel. Since we mentioned Intel, we'll do a technical analysis of it. Now, Intel has gapped down lower. So this is bearish. Simply looking at the company stock price, 1 hour, 4 hour. This is bearish. Very bearish. It's at 26, so a bearish, strong bearish market sentiment. So where is support? This is the current price that it closed on. Right around here, I would place my S1, 37.75. Then I'd move lower. Let's look at the size of the candle. So if we place it around here, we might actually find support. So low here, this would be too far away. And then for S3, 2 candles, so found support, moved higher. So I have S1, S2, and S3. We could even bring S3 a bit lower or S2 higher, but it's on S1, so perhaps it's best we keep S2 unchanged and then simply bring S3 lower. Roughly looks to be equal in distance. R1, where it gapped down lower, heavy selling pressure, pre-market, and then open lower. That's R1. R2 at this old high. R3 at this even older high. But then if I'm keeping my resistance levels, that means my support might be too far away. Unless we readjust and place R3 at a higher point. Now, if we were looking at this from a day trader's point of view, this wouldn't be my support and resistance levels. The technical analysis we're doing here on the terms of support and resistance for stocks, so Intel, UBS, ExxonMobil, we're doing them from a more macro perspective because we might not cover them on a daily. So hypothetically, if someone would place our support and resistance levels and would monitor them as well, these could be valid in a week's time, etc. Whereas euro dollar, cable, etc., which we look at on the daily, are more frequently updated, and thus support and resistance might be a bit closer. But since Intel, we don't really cover Intel on the daily in terms of technical analysis. I'm placing support and resistance levels at more intermediate support and resistance levels. So yes, it might find resistance here, but from a more macro perspective, this looks like a stronger resistance level than this interim high. Support currently testing. But if I place my support here and today this breaks below, then what's the point? There's no reason in me placing my S2 level here if it's going to be broken today and I'm not going to be covering it. Whereas by tomorrow, if it does break, this would be our next target. Since we have roughly 24 hours between each live and we don't really cover on the daily these stocks, would make sense for us to place support and resistance thinking ahead or looking from a more macro perspective. Whereas euro dollar, it's more short term. Yes, it's not from a day trader's point of view, but still updated frequently. So we could even say that S1 could be higher, could be around here for today. 1.0820. Actually, I wanted to coincide with these two candles. 0.5. Uh, 1.5. see, 0.1, and then you could bring us to here. And then I'd bring us to here. So this would be for looking in front for this week, perhaps. Still not a day trader's POV, but more short term rather than what we're doing with Intel. And with that, that does it for today. Thank you for watching, and we'll see you all tomorrow.
Okay, thanks for waiting, everyone. Let's go ahead and get started. So, welcome to this week's webinar on the second part of our Fibonacci series, which will be on Fibonacci extensions. So, before we get started, as per usual, a risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. A disclaimer: the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so I'm Melanie. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX and Equity Research in the years 2019 to 2021. Okay, so here is our agenda for today. We will do a brief recap of the Fibonacci retracement essentials that we went through last week. And then we'll look at ideal market structure. So what are considered significant swings, how you can follow market trends, and then the different Fibonacci retracement levels, followed by this week's Fibonacci extension slides. So then we'll look at Fibonacci confluence and how you can combine what we learned last week, so Fibonacci retracement, with this week's extensions. Okay. Feel free to let me know in the chat throughout the webinar if you guys have any questions. Let me just change the settings so that you can ask me in the chat or Q&A. Okay, should be okay now. Okay, so let's get started. So starting off with a quick history lesson on the origins of Fibonacci. So Fibonacci retracement levels were named after Italian mathematician Leonardo Pisano Bigolo, who was famously known as Leonardo Fibonacci. So, however, he did not create the Fibonacci sequence. Instead, he introduced these numbers to Western Europe after learning about them from Indian merchants. So, Fibonacci retracement levels were formulated in ancient India between 450 to 200 BCE, and the sequence is also referred to as nature's numbering system. It's often observed by known people in flower patterns, hurricane patterns, and galaxies. So here's our recap on last week's Fibonacci retracement. So a very simple checklist to follow when you're first starting out with Fib retracements, and I guess some things to look out for. So firstly is the market structure clear. So we want to look for big zigzag patterns, and we'll show you some examples in the coming slides. Next, we're looking for recent trends. So we want to identify, is the trend going up or down? And it's always important to follow the general trend. Next is to identify recent major swing lows or recent major swing highs. Again, we'll show you some examples of those. And we want to connect the two extreme points like you see in this slide here. So we're starting in this example because it is a downtrend. So we're starting from the highest point and then ending at the lowest point for a downtrend. And then if it's an uptrend, we're looking at the lowest to highest points. So here's an example of a clear market structure. Okay, so although Fib retracements and all the different Fibonacci techniques can be used in both choppy and trending markets, it's still important to look for clear market structures regardless of what technique you are using. So here's an example of a clear market structure, and here's an example of an unclear market structure. So one of the ways to identify a clear market structure is actually by adjusting the time frames in order to get a clear market structure for you to conduct your Fibonacci analysis on. Okay, so what may look messy on a M30 chart might actually look very clear on an H4 chart. So if there's too much chaos in the shorter time frames, it doesn't mean that the entire currency pair is not able to be analyzed at that point in time. So it just could simply mean that you need to take a step back or sometimes a step forward to get a clearer view. So in this example, you can see we have a pretty unclear market structure from the 15-minute time frame. So it's quite messy. There's no clear movements in price, and when we change it to the 1 hour time frame, you can see that the highlighted portion has a much clearer market movement. Okay, so there's basically two criteria that you should look out for. Firstly is a clear swing low. So the clearer the swing high, the clearer the trend between these 2 points, and the more accurate your Fibonacci retracement will be. Okay, so I guess now we'll briefly go through what conditions to look out for when we're using the retracement tool and how we can use it on both MT4 and TradingView. So if we have time at the end of this webinar, I will do a brief market analysis. Feel free to let me know if you have any requests in the chat, and we can do a bit of Fibonacci analysis on TradingView as well. But starting off with MT4. Okay, so here's just the layout on MT4 if you're unfamiliar. So now let's zoom into our toolbar. So when you hover your mouse over this option, where my mouse is here, it should say draw Fibonacci retracement. So you just click on that, and you can click on wherever you want your Fibonacci retracement to be. So it should come out looking like this. And if you want to add or edit any Fibonacci levels, you simply right click on the Fibonacci trend line, and then So it's pretty faint over here. There is a red dotted line. Yeah, but this is what you will get when you right click on it. So you click on Fibber Properties, and then under the Fibber Levels tab, you can then click Add, and you can proceed to add whichever levels you wish. Okay, so here you can see, yep, it'll look like this. I click Add, and then I've added a negative 0.618 level, which is essentially just minus 61.8%. Okay, so now looking at Fibonacci retracement tool on TradingView. Okay, we have a typical layout. In this case, we're looking at pound dollar for this example. But basically, you click on the Fibonacci retracement tool, which is the symbol with the 4 horizontal lines over here. So you can find this, I think you can find this on the top bar or the sidebar. Yeah. Here you can see I've circled it out. And then after you've connected your Fibonacci trend line, this floating bar will pop up over here. So when you click on settings, this selection box will appear. So you can select any other levels that you wish. So if you weren't here for our previous Fibonacci session, I'll show you guys in a little bit, but depending on which Fibonacci technique you're using, we will look at different levels. So let's say in this case, I'm looking at all of the relevant levels from negatives to more than 100. And when you're first analyzing the levels, you want to kind of select both negative, mid-range, and above 100 so that we can view all 3 Fibonacci types at once. So this is what I mean here. From minus 61.8 to 161.8. So the negatives are what we call Fibonacci expansion. Okay. Today we are going through the above 100s, which are the Fibonacci extensions. So we are using the 127.2 and the 161.8. And next week we'll be looking at the expansions, so the negative levels. And last week, the retracements, we looked at the mid-range levels, so 23.6 to 78.6. Okay, so yeah, we'll go through expansions more in depth in the next webinar. So I'll just briefly introduce these levels now. And if you look at the GIF that I've included here, this is the kind of shape that we're looking for. And this is how exactly you should draw your Fibonacci retracements. Okay, another example here, you can see all the different Fib numbers that we mentioned in the previous slide and how it looks drawn out. So basically just take note of the starting point and the ending point of your Fibonacci trend line. So in this case, you can see the general trend that we're looking at is a downtrend. So the starting point is 100%, ending point 0. Okay. In this case, this is also another example, and we can see that price bounced off the highlighted area of 61.8% at the Fibonacci retracement level here. Okay, here's another example. In this example, we're looking at the 38.2% Fibonacci retracement level, and this is in line with the overlap support at the 32544.21. So you can see price bounced off of this highlighted area here. So if you are unfamiliar with what an overlap support is, you can stay tuned for our support and resistance webinars where we go really in depth into overlap and pullback support and resistance. But really briefly, overlap basically means that there are swing highs and swing lows that match up at the same level. Okay, and those tend to be really powerful or really significant levels, especially if they line up with our Fibonacci level that we have over here. Okay, another example here. So here we have 2 Fibonacci retracements. First one is from the top to the bottom over here. And we have 61.8% that lines up with our 0.92637 level. Okay, and next we have another level, or rather another retracement from the bottom to the top over here. And we have 61.8% Fibonacci retracement again that lines up with the 0.91614 level. Okay, and for this level, we actually have it matching up with two swing lows. So this makes it a pretty significant level. Okay. Okay, just a really brief example of an expansion. So for an expansion, we are looking for a flash kind of symbol or lightning bolt symbol. So here you see in this example, it kind of looks like a lightning bolt with from the arrows. So starting point is here, ending point is point 2. And here we're looking at the negatives, as I mentioned earlier, for expansion. So expansion, we're looking at minus 27.2 as well as minus 61.8. So in this example, we can see the 61.8% lines up with this swing high here. So we're expecting price to bounce off of the 61.8% level. Okay, and we're projecting it to hit down towards the minus 27.2%. Okay, and you can see this is the outcome of that. So you really have confirmation that price is going to hit downwards once price breaks out of your initial ending point, which is at point 2. So that's how you combine a Fibonacci retracement with your Fibonacci expansion, since they both use the same tool, just that we're looking at different levels. Okay, so you can see here, once price broke below our ending point at point 2, we have confirmation that it's going to hit towards our minus 27.2, which it did, and it bounced up nicely from the minus 27.2% Fib retracement and hits back up to the ending point, which it normally does after bouncing off either the minus 27.2 or the minus 61.8. Okay, so let's get into this week's Fibonacci extension. So here is an example of price reacting off the 161.8% Fibonacci retracement level, resulting in a reversal. So in this case, extensions, we like to look for Nike tick shapes. Starting at the starting point will be here, ending point over here. So we are taking, how you draw your trend line is you're basically drawing the head of the tick. Okay, and the projected level is either 127.2 or the 161.8 like we see here. So price has broken out of the 127, so we're projecting it to bounce off of the 161.8, which it did, and results in a reversal over here. Yeah, before we move on, I'll just show you guys the Forex Army page. Let me see. Okay, so in this website, you can see how exactly you can draw a Fibonacci retracement correctly. So, yeah, basically everything that I've gone through today, last week, or future webinars, most of the information will be over here. So you can see the clear structures that we went through earlier, how you can follow price structure, yeah, and this clear steps on how to draw your Fibonacci retracement, some examples. So feel free to check out this website after this webinar. Yeah, it also goes through Fibonacci confluence, which might be a little bit confusing since we are combining all the techniques. Yeah, so you can see over here, we have a bunch of examples. So yeah, let me just pop it into the chat for you guys. Okay. Now let's look at when does a Fibonacci retracement become invalid. Okay, here. So one of the most common scenarios of this is when price makes a lower low. So assuming you are drawing a Fibonacci retracement from the top to the bottom, or if there are bars on the right that break your ending point, then it becomes invalid. So I think we have a bunch of examples of this later on. Yeah, so just because it becomes negative doesn't mean that it is invalid, because we've already gone through that Fibonacci expansions are negative levels. Um, okay, but I'll show you guys some examples later on. Okay, let's combine some Fib retracements. So we have three different methods here. Firstly, we have the minus 27% Fib expansion, and this lines up with a 161.8% Fib extension, and then the 78.6% Fibonacci projection. So what we want to take note of from this example is basically the shape of all of these trend lines. So firstly, the extension, you can see the Nike take. Over here, it's kind of an inverted Nike take. So the head is here, the gray arrow, and then the tail would be the long black arrow. Fibonacci projection also uses a lightning bolt shape similar to the expansion, so you can use those together. So Fibonacci expansion, you can see the trend line that we are following from the red arrow, and then for Fibonacci projection, we're looking at the black arrow. Okay, and we can see that price bounced off of the Fibonacci confluence area over here. So that's how you use confluence. Another example, here we have 61.8% Fibonacci retracement matching up with a 100% Fibonacci projection. So in case you can't see the lightning bolt shape, I've drawn out the arrow. So the yellow arrow here is the Fibonacci projection, and the blue arrow, which is just a one straight line, is your Fibonacci retracement. Okay, and we can see price bouncing off of that confluence area there. Okay, another example here. So here we're using retracement and projection. So the 23.6% Fibonacci retracement is just one line following from this bottom here to the top here. And that is in line with our 61.8% Fibonacci projection. So for projections, it's 3 points. So we have a starting, middle, and ending point. And we can see price testing this level here. Okay. Okay, so let's backtrack a bit and look at how exactly you can use these retracements. So how do you identify clear market structures? Firstly, we want to look for significant swing highs, swing lows, significant trends, or clear market trends. So let's first look at an incorrect example. Here's an example of insignificant swings, which are bad points to use for Fib starting and ending points. So you can see it's really messy, the price movements are too small, and there are no significant swing highs or lows. Another example is over here. So there's no clear swings, no clear market structure. Price movement is too small to use any kind of Fibonacci technique here. So here is an example of significant swings. Okay, we have a clear move up and down. We have obvious peaks and troughs, and very clear market movement as well. And here's another example. So I've drawn out the peaks and the troughs to show you exactly how clear it should be. Okay, and following the market structure. So we want to pick market structures with a clear upward or downward movement. So your Fibonacci retracement trend line can follow that movement. And this works better on higher time frames due to there being less noise. So by higher time frames, we mean H1 onwards. So H1, H4, daily, weekly, yeah, depending on your trading technique as well. Okay, so um, you can see this is an example of not following the market structure. So this is how not to draw a fib retracement trend line. You can see we have a zigzag here, okay, but instead we are drawing a fib trend line through the price structure, when instead we should be following it exactly. Okay, so when your retracement is cutting through the market structure, it makes it less effective. Okay. Okay, so for our Fibonacci extension, getting back to this week's topic, again, the tool that we use is Fibonacci retracement, and the percentages are 127.2 and 161.4. And here we're looking for a Nike tick, like you see in the GIF here. Okay, and these tend to be quite powerful setups. If they don't react off of the 127.2, then we're likely expecting it to react off of the 161.8. Okay, and these usually retrace the entire move from point 1 to 2, hence the retracement tends to be more than 100%. So the clearer the movement of the Nike tick, the better. So you can take a look at this GIF over here. So you can see it did test the 127.2 slightly, but it still broke out of it and reacted off of the 161.8 before reversing back down. Okay. Okay, so another example here. So for fib extension, in this example, we are looking at it reacting off the 161.8. And then we see a reversal here. Yeah, I think we saw this earlier, so I'm going to skip that. Here's another example. So this is on the daily time frame. And you can see that there is a swing high that's in line with the 127.2. It's quite small. So these, obviously, the clearer the Nike tick, the better. But if you have a small movement like this, that works as well. So if we zoom in, because this is on a daily time frame, so if we zoom in and view the same chart on a H4, we can get a clearer view. Yeah, so you can see here the Nike tick is a lot clearer. Okay, and this is on the same chart. So we can see how price reversed nicely off the 127.2% fib extension level here. Okay, and here earlier I briefly mentioned an inverse Nike tick. So in this example, you can see it a bit clearer. Starting point here, ending point here, and then the tail would be from the 0% all the way down here. Okay, so as long as it retraces 100% of the tick, then it can be considered a tick. You know, as long as it reverses 100% of the V shape, then it's considered a tick. So we want to take note of the swing low support at 0.91565 in line with the 161.8% level. Okay, so this makes it a strong support level where price bounced off of. Okay, so we'll talk a bit more about combining the different fib methods as well as the support and resistance levels so that it increases the accuracy of your analysis. Okay, let's move on. So we talked about invalid Fibonacci retracements earlier. Okay, and I did mention as well that the fib retracements that are negative are still valid. Okay, and this is an example here. So our starting point is here, ending point here. Price breaks our ending point, as we see from this area over here, under the red arrow that I pointed out here. And once it breaks out of it, it's no longer valid. So basically, when it breaks out of your 0.0% level and has made a lower low, that's an example of an invalid retracement. So you want to remember to always pick the lowest point with nothing on the right of the ending point. So your ending point is here. We don't want anything lower than that over here. Okay. Let's quickly get into Fibonacci confluence. We briefly talked about it, but I'm gonna get a bit more in depth into the extensions. Okay, so we looked at this example earlier, but it's basically multiple Fibonacci levels. It doesn't have to be retracement only. As long as there are Fibonacci methods that line up nicely, it's considered confluence area. So you're basically lining up these levels so that you can increase the probability of a bunch of Fibonacci levels working versus a single Fibonacci level working. Okay, so yeah, we looked at this example earlier. So in this example, we have two fit methods. Okay, I mentioned earlier the Fibonacci extension, which we just went through, and the Fibonacci projection, which uses a lightning bolt symbol. So our 61.8% Fibonacci projection, like you see here, lines up with the 127.2% Fibonacci extension. So the Nike tick, if you can't see, the head of the Nike tick is from here, this swing low to this swing high. And because it has surpassed 100% of it, or it's retraced 100% of that, the head of the V shape, then we can use it as our extension. And for our projection, we are looking at the starting point here, middle point here, and ending point at the swing high. Okay, for projections, we use 61.8, 78.6, and the 100%. So here we're looking at 61.8, which lines up nicely with our 127.2% extension level. Okay, and you can see how price bounced off nicely off of that level. Okay, but in this case, you can see it's just the wick of the candlestick that's just touching that area. So we'll go through in a bit how exactly you can maximize your chances of catching this reversal since it is just a candlestick wick. Okay, next let's look at another example. So here we also have two Fibonacci methods. We're using extension and projection again. Our extension here is not an inverse extension. Okay, so we have the hit, the starting point at the swing high, ending point at the swing low, and it is past 100% of the V shape, as you can see here. So that's why we're looking at 127 and 161.8. Fibonacci projection wise, we are looking at the lightning bolt shape again. So starting point here, middle point here, and ending point here. Okay, so 100% Fibonacci projection lines up nicely with our 127.2. In this case, we can see that our 100% also aligned, or rather our 78.6 Fibonacci projection also lined up nicely with the 61.8% Fibonacci retracement. Okay, but it already surpassed that, so it's no longer valid. Okay. Okay. Last example, I think. But basically in this example, we are looking at an expansion and an extension. So for expansions, remember we're looking at the negative levels. So for expansions, we're also looking for a lightning bolt shape. So the lightning bolt shape is like this. The minus 61.8% lines up nicely with our 161.8. So you can see that the minus 27.2 expansion also lines up nicely with the 127.2. So when we identify these two confluence levels, we would first wait for price to break out of this confluence area before going in for a buy towards this confluence area here. Okay, in this case, obviously it broke out of it, so we were going for that buy. But if we didn't know that it was going to break out of it, we would first going for a buy towards this area here first. Okay. Okay. Okay, this is our last example. So in this example, we have the minus 27.2% expansion, which is the blue arrow. Okay, and that lines up with our 100% Fibonacci projection, which is the lightning bolt shape. Starting point, middle point, and ending point, as indicated with the orange arrows. And then the purple is our Fibonacci extensions, or in this case, we have an inverse Nike tick. Okay, so we have minus 27.2, 100%, and 127.2 lining up. So we can see that price bounced off nicely off of this very strong support level. Okay, so normally you would try to get as many Fibonacci techniques as you can lining up at the same level because that gives us a stronger confluence area. Okay, so it's a more effective indication that price is going to bounce off of that or reversal is going to happen. Okay, so let's talk a bit about trade management. So earlier I showed you guys how sometimes with confluence areas, you can expect a very brief reversal. So a very brief touch on our confluence area before it starts reversing off of it, especially when you have a very strong confluence area with multiple Fibonacci levels lining up on it. So in order to avoid missing your trade, this is the trade management technique that we like to follow. So firstly, your stop loss will be placed beyond. So this means that you would place your stop loss beyond a key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of confluence, and if your stop loss is right before instead of beyond it, you will most likely get stopped out before the market reverses. So that's basically what I mentioned earlier. In this example here, um, we're going in for a buy. Okay, so our stop loss will be placed below your Fibonacci confluence. And your take profit, we recommend you to place it before. So in this case of a buy entry, we would place our take profit below the confluence area. Okay, obviously these will be switched if you are looking at a sell entry. But yeah, basically the standard rule is that stop loss will be placed beyond a key Fibonacci confluence area and a take profit will be placed before it. So before means that you should place your take profit, in this case, below the confluence area. Reason for this is because when price reaches the confluence area, there's a high chance that it will not be able to go beyond it. And instead of reaching your profit target, it might reverse back to your entry or even worse, your stop loss right before it reaches your take profit. Okay, so that's also one of the reasons why people complain that the market is being manipulated because they miss their take profit by 1 or 2 pips. Okay. Okay, let me know if you guys have any questions. We still have a bit of time. So I'm gonna pull out my charts, and if you guys have any requests for any currency pairs you'd like me to go through, feel free to pop them into the chat. Okay, I got a request for okay. DOW 30. Let's go ahead and look at that. Mm, can you just really quickly drop the ticker in the chat? I can't seem to find it on TradingView. Is it this one? Is it this? Okay, let's go ahead and analyze this first. Can you guys still hear me? Okay, let's continue. So, let's start off by looking at it on the higher time frames. Okay, so okay, we can see a general downtrend on our daily time frame. Let's look at our weekly time frame. Okay, weekly time frame is pretty bearish as well. Okay, okay, I'm just gonna go in and add some support and resistance levels. So here's our first resistance. Here's our first support. And here's our second resistance. Okay. Okay, let's look at our 4-hour time frame. So we kind of have the same levels here. This is our first support. Yeah, okay. Okay, let's look at Dow Jones. Okay, so same thing, we're gonna look at the higher time frames first. So it's pretty bullish, okay, on our weekly time frame, on our daily time frame as well. Okay, here is our first resistance. Okay, this is our first support, and I think this would be our second support. Okay. So if we're looking at our retracement, we're looking at the mid-range first. So we have these 5 levels, 23.6 to 78.6. And I can see that my 38.2 lines up nicely with my first support. Okay. Let's see. Okay, let's look at this on our 4-hour time frame instead. Okay, it's pretty similar. Okay, now I'm gonna look at a projection. So for projection, we use these 3 levels. Okay, and okay, actually here I can show you guys an example of a Nike tick. Okay, we're looking at the above 100 levels. Okay, so 127.2 and 161.8. And you can see the shape of the Nike tick here, right? So it's surpassed 100% of the V shape, which is why we can use it. And you can see price actually rebounded off of the 161.8 level, just as we suspected or would expect. Okay. So yeah, that's an example of the Nike tick or Fibonacci extension that we went through today. Okay. Let's see. So because of that reversal of the 161.8, we can expect it to continue to go down towards this level now, which is our 23.6 level. Okay, so I might just put an indicator there. Let's see if we have previous levels. Okay, kind of have this level here as well. This would be just an intermediate level. Okay, that I'm expecting price to hit towards. Okay, now let's look at some indicators. So I like to start off with Ichimoku and MACD. So if price is moving below the Ichimoku cloud, it is a bearish signal. And if it's moving above, then it's a bullish signal. So in this case, we see price moving above, so it doesn't support our analysis that price is going to drop down to this level here. Okay, so I'm going to get rid of that. And MACD, you can see that it does support my analysis. So I can keep that. And let's look at RSI and stochastic. RSI, you can see very obvious downtrend. So it also supports my analysis. Let's look at stochastic. Okay, stochastic as well. Okay, let's look at maybe Bollinger Bands. Okay, so you can see that on our Bollinger Band, price is moving out or it's breaking out of the bottom band of our Bollinger Band. So it's also supporting our bearish analysis. Okay, so out of the 5 indicators that we've used, 4 out of 5 of them have given us a bearish signal, which supports our analysis. Okay, so because there are so many indicators, 50% of them will give you bullish and 50 will give you bearish. So it's important to just learn a couple that you're comfortable using, that you know how to use, and then stick with those. Use those interchangeably to support your analysis. And yeah. Okay, any other requests. I think we have time for maybe one more. Okay, no worries. Mm, okay, let's look at gold. So on our weekly time frame, it's pretty bullish, right? On our daily time frame, also pretty bullish. Um, okay, there's not a trend line, but let's see if we have a trend channel. Okay, I think we can see price breaking out of the trend channel. Okay, we might see it break out a bit. Okay, let's go in really quickly with some levels. So this is our first resistance, our first support, and our second support. Okay, on our 4-hour time frame, okay, I'll just show you guys an example of a Nike tick again. Here, okay, you can kind of see this Nike shape or tick shape. Okay, and you can see it bouncing off of the 161.8. Okay, yeah, and okay, so this would be my first resistance. Um, this is my first support, and then my second support here. Okay, so going in with a projection again, it's in line with my 61.8. Mm, okay, my 38.2 lines up with my first resistance. Okay, and okay, I think that's about it. Okay, so my 23.6 also lines up with my first resistance, and so does my 61.8. Okay, so we have this confluence area here. And this is also a pretty significant level of overlap, okay, because we have a bunch of swing lows lining up as well. Okay, now let's pull out some indicators. Okay, price is moving below the Ichimoku cloud, so it's giving us a bearish signal. MACD is also giving us bearish signal. If we look at RSI, Okay, RSI isn't telling us much. Let's look at stochastic. Oh, okay, so we have a bit of divergence here. So price has made a higher high on our price chart, whereas on our stochastic, it's making a lower low. So this is a bearish divergence and could suggest that price is going to continue to break below our first support. Yeah, but we'll have to see because this is a pretty significant level here. So you might see a bit of a jump. Okay, if I zoom in, you can see price already increasing here. But ultimately, because of all the downward pressure, we might see it continue to drop below the first support. Okay, maybe let's look at moving averages as well. Okay, so the SMA and EMA price is moving below both of these indicators and it recently crossed over each other, which could suggest a change in trend. And it's been pretty uptrend recently, and now we're seeing a downtrend. So that could be because of that. So also supports our bearish um analysis. Okay. Okay, I think that's all the time that we have for today. Um, Let me see if we have any other questions. Okay. Okay, if there's nothing else, thank you guys so much for joining me today. I hope you guys found it helpful. Have a great rest of your week, and I'll see you guys next week. Bye, everyone. Thanks, everyone. Bye.